Okay, let's dive right into this. What if I told you that Elon Musk didn't become a trillionaire because of his salary? Welcome to The Explainer. Today, we are unpacking one of the absolute most fascinating financial mysteries of our time, exactly how this fortune grew so massive that it actually crossed into the trillions. We aren't just looking at the companies he runs, right? We're looking at the fundamental mechanics of how extreme wealth is actually constructed from the ground up. I want you to start by asking yourself something. What does a trillionaire's bank account actually look like? If you're picturing, I don't know, a basic checking account with a 1 followed by 12 zeros, you need to completely erase that image from your mind. That's a massive illusion. Extreme wealth, like the kind that makes history, is almost never about liquid cash just sitting around in a giant vault somewhere. It operates on an entirely different set of rules. In fact, right up until 2021, Musk frequently described himself as being cash poor. Seriously, let that sink in for a second. The man who would eventually become the wealthiest person on Earth was cash poor. And this introduces the core thesis of our explainer today. True wealth is all about ownership, not liquid cash. If you can understand this paradox, well, you basically understand the billionaire blueprint. To kind of ground this abstract scale, let's look at a very specific date. June 12, 2026. That is the exact day Elon Musk officially crossed the $1 trillion mark. On that day, his personal wealth actually surpassed the combined wealth of the bottom 46% of the entire global population. That is 3.8 billion people. It's a staggering figure, I know, but it wasn't built overnight, and it absolutely wasn't built from a standard biweekly salary. So let's see how this all builds, starting with the main catalyst. Back in 2002, eBay acquired PayPal, and Musk walked away with roughly $180 million after taxes. Now, think about it. Most people would have bought a mega yacht and retired to a private island, right? But Musk didn't. Instead, he took all those chips and played a much, much bigger game. He bet it all on high-risk, pre-revenue ventures that most investors at the time thought were absolute jokes. He put about $100 million into SpaceX, $70 million into Tesla, and $10 million into SolarCity. Basically, he used his fintech fortune as the starting capital to build real physical assets. But, betting it all meant risking it all. By 2008, Tesla was staring straight into a financial abyss. The pressure had been building up for months. First, there were brutal strategic clashes with a major investor named Alan Salzman, who just wanted Tesla to sell batteries to legacy automakers. Then, just weeks prior to the breaking point, there was an attempted boardroom coup to literally oust Musk as CEO. And finally, Christmas Eve. The ultimate deadline where Tesla was literally hours away from running out of money to cover payroll. The company desperately needed a $20 million equity injection just to survive, but Salzman refused to approve the deal, effectively blocking the whole thing. So, with survival literally hanging by a thread, Musk engineered this desperate but honestly brilliant zero-hour pivot. He completely restructured the financing plan to avoid issuing more equity and decided to take on more debt instead. This completely bypassed Salzman's veto. The deal went through on a Christmas Eve conference call. And this proves a really crucial point. Musk's immense wealth, it was never ever guaranteed. It was forged in these moments of extreme existential corporate risk. Now, as you can see here, there is a massive difference between working in a business versus working on a business. When a founder runs literally everything, they might feel completely indispensable. But to buyers and investors, that just looks like dangerous dependency. If the founder is the entire machine, the company's value is incredibly fragile. It severely limits how much the business can scale. So, the crucial step is overcoming that dependency. It requires a really strategic period of decoupling. By dedicating time and capital to decouple operations from the founder, hiring executives, standardizing supply chains, building a system that actually survives without him, the business completely transforms. It stops being this fragile little startup and becomes a highly scalable asset. And that massively multiplies its valuation on the open market. And this specific shift in strategy is exactly what allowed Tesla to achieve what we call a valuation moat. For years, critics basically valued Tesla like a traditional legacy automaker that was facing a growth slowdown. But then, the market started pricing it completely differently. They began valuing Tesla as an AI and robotics platform, the anticipation of fully autonomous vehicles, like the Cybercab, and the Optimus humanoid robot created a sustainable competitive advantage. This huge paradigm shift in how the company was defined is exactly what supercharged its market premium. And the data driving that premium in 2026 was just undeniable. The Cybercab moved into mass production in April, completely aiming to disrupt the industry with its lack of steering wheels and pedals.
Full self-driving subscriptions jumped up, generating between $1.3 billion and $2.6 billion in high-margin recurring revenue. And simultaneously, energy storage deployed a record 14.2 gigawatt hours. This huge transition from just selling physical hardware to securing high-margin software subscriptions and energy infrastructure is exactly what pushed Tesla's stock valuation straight into the stratosphere. Now, we also really need to look at the structural environment that allowed these companies to scale in the first place. Over roughly 2 decades, Musk's companies utilized at least $38 billion in government contracts, loans, subsidies, and tax credits. NASA and the Department of Defense provided these crucial, guaranteed revenue streams that really de-risked early investments in SpaceX rockets. Meanwhile, federal EV tax credits and clean energy subsidies acted as these sort of mechanical inputs that bolstered Tesla's balance sheet and stimulated consumer demand during some really critical growth phases. So all of these elements, the immense risks, the decoupling, the valuation modes, and the strategic scaling, they all culminated on one historic date, June 12, 2026. This was the day of the highly anticipated SpaceX initial public offering. Shares priced at $135 and very quickly began trading on the Nasdaq at $150. SpaceX entered the public markets with a staggering valuation approaching $1.8 trillion. This IPO was the specific financial engine that officially propelled Elon Musk across that historic $1 trillion net worth threshold. So what does a trillion-dollar portfolio actually look like? Well, it is entirely sliced into corporate equity. About 42% comes from his massive stake in SpaceX. Another 20% comes from Tesla. The remaining 38% is tied up in other ventures like XAI, Neuralink, The Boring Company, and enormous performance-based stock options. So his fortune is highly concentrated and totally illiquid. That means if these stocks drop, his wealth plummets instantly. It's wildly volatile, but keeping his wealth and appreciating assets is infinitely more powerful than taking a regular cash salary. Which brings us to the ultimate takeaway of this whole explainer. It's the fundamental difference between the traditional mindset and the billionaire blueprint. Employees earn salaries, right? Their income is linearly tied to the hours they work. But business owners, they build assets. When you build or invest in an asset, whether it's a technology platform, a rocket company, or energy infrastructure, its value can multiply exponentially without you ever receiving a larger weekly paycheck. Wealth is created by decoupling value from direct labor. Whether you admire the risks he took or heavily scrutinize the methods he used, understanding the mechanics of this trillion-dollar fortune completely reframes how we think about money. It's really not about how much cash you have, it's about what you own. So I'll leave you with this question to think about. How are you applying the concept of ownership in your own life? Are you just earning income or are you actually building assets? Thank you so much for joining me on this explainer, and I'll see you in the next one.